the stair-step process. But the market has to kind of refresh as it goes along, or else it gets overbought. Then you get a bigger correction. So what we've had is these healthy pullbacks. I've said for a long time, we're in a melt-up. I think we started the melt-up last October, and that we would have short, sharp corrections along the way to kind of refresh and build that wall of worry back up to provide fuel for the further advance. That's what I think this last couple of weeks was about. But the market, because it's been almost straight up, it's been a steady, up and away, the investors seem very non-resilient when it comes to any kind of pullbacks. They've been skeptical of the bull market that's been in place since October 2022 anyway. So the minute it starts rolling over, they don't understand why it's up on these stilts. So the minute it starts rolling over, you hear them coming out of the woodwork calling for a crash, calling for, at least a 10% pullback. And maybe that's wishful thinking for a lot of them who missed the rally. I don't think you're going to get those kind of pullbacks, but you can get what we just had was a 5% pullback in the S&P, a little bigger in the NASDAQ. But I think it's over. Yeah, today, you're reversing in a big way. I don't think you're going back. So I have been on Twitter today saying I believe we are just beginning what I call the final parabolic leg to this market. So we've had what I call melt-up, which is disproportionate rally, not a normal rally, but something much bigger. We've had that this last several months, and I think the next leg is even steeper. It's what I think will be the final stage, the parabolic stage that carries you into a 42-year secular top. So I think this secular bull market started back in August of 1982, and we've had some cyclical bulls and bears along the way, but I think we're reaching the final stage, a 42-year top or 42-year secular bull market that ends in a pretty spectacular top here, and then I think the other side of the mountain starts. I have long said that the Fed doesn't set rates, the bond market sets rates, or the bond market determines rates. The Fed can set the overnight rate, that's what the Fed fund rate is the overnight rate that the banks charge each other to, borrow and lend from each other. That's all they really control is the short rates. The longer rates are controlled by the bond market. The bond market in its aggregate, not any individual, but in its aggregate, the law of large numbers, the bond market's a far better predictor of where we're going, both in rates and in the economy, than I think is the Fed. So all these people that spend all their time thinking, spending all their time wondering, is the Fed going to cut this time or next time? How much are we going to get? I think it's a giant waste of time. The Fed follows the bond market. The Fed doesn't lead the bond market typically. So bonds have already fallen. Bond rates have already fallen. You've taken the 10-year down from 470 a couple months ago to I think today we got to 411. So you've already had a huge cut in rates, and 10 years far more important than the overnight lending rate for banks. And the bonds market setting now way ahead of the Fed. So the Fed's spending its time looking backward-looking data, and I think they've waited too long, but it doesn't really matter because the bond market's doing the job for them. Going forward, I don't know what they're going to do month to month, but my guess is we could have, as many as 3 or 4 cuts into the end of the year. If they cut today, we could have 4 cuts. If they start September, I think you'll see a September, November, and December cut because the economy is slowing. Because I think the Fed has overstayed its welcome on the tight side. They think they can, as every cycle, every time the Fed thinks they can micromanage this thing down to when it's time to cut. And they always wait too long because of the leads and lags. So I think they're doing that again. And the problem this time is that we are a far more leveraged economy, a far more leveraged system than even back in 2008 and 9. And, way beyond anything we've ever seen in history. We've got 320 trillion in global debt. We've got quadrillions in the notional value of derivatives. That's leverage that's off the charts, never been there before. And leverage on the way up can enhance returns, but on the way down, it can really exacerbate things. So, if you make a mistake as a Fed and stay too long, we saw in 1974, we saw in 1982, we saw in 2003, we saw in 2008-9, that by waiting too long, we got a harder landing, right? The economy took a big hit in each of those cycles. This time, I think it's going to be even bigger. bigger because of that leverage. So in other words, the policy error of waiting too long gets magnified this time because of that. So they're trying to tune this thing down to the week and month, and well, we better not go too soon. Meanwhile, under the surface, you're seeing lots of disturbing things that say this economy could decelerate quickly. And so that's why I have such an extreme view that we go up into this top, and I've been way ahead of everybody else and way higher in terms of my target. But right behind that, I've said for a long time, we're going to get a global bust, and I define a global bust as something bigger than a normal recession, but not the length of a depression. So it'll be fast. It'll probably be contained within 2025, but it'll be more damaging than 2008-9. Pieces of or glimpses of what I'm talking about in other cycles, but nothing comprehensively looks like this. 20 certainly was, a fall off a cliff in terms of the market, and then followed by a long depression. We had in 2008-9 probably the closest thing to this. The reason that I think this will pattern a lot like 2008-9, what I say is that the difference is in 2008-9, in October of 2008, commercial paper market froze up. And if the Fed hadn't reacted quickly or the policymakers hadn't reacted quickly, you would have seen companies like General Electric go under. They depended so much on financing overnight, but they did react just in time. If they hadn't, I think you would have seen a bust in 2008-9. So this one is that point in time, except they don't have the luxury of being able to save it before we go over the cliff. And so it's just a bigger downside in the markets, probably a bigger banking crisis around the world. I think, major banks are going to fail, and, maybe not so much this time in the U.S. because of what happened in 2008-9. Our banks were forced to get deleveraged. And so they'll be hit hard, but maybe not as hard as they were in 2008-9. Whereas Europe, I think, can get hit much harder. Canada, I think, didn't learn the lessons of 2008. They were in much better shape than we were then, and now they look like we were then. So they could be in trouble, and obviously their real estate's up on stilts. Australia has a lot of problems because of their real estate, etc. So I think it's going to be a worldwide problem, and it'll come to the U.S. The counterparty risk and everything, and the ties in the banking system around the world means we're not going to avoid it in any way, but I just don't think you're going to see quite the comprehensive failure you saw here back in 2008. I think, you look at what we've had in the last, 3 or 4 years in terms of so-called civil unrest, the Antifa over here. You look at what just happened in Venezuela, with a stolen election. I think our election was stolen in 2020, as much as some people may not believe that. There's a lot of evidence. So we've started that process. The response here has been pretty tame. I would guess it's going to continue to be controlled up through this decade. I think the real unrest, the real unknown in terms of what happens is in the worldwide collapse I see, whether it's 2033, 34, 35, I don't know exactly when, but I think during that, people are going to be, fighting for survival. As I put it, and this is just in the States, but I think it'll apply across the globe. I think I can draw a scenario. Again, it's total seat of the pants. I don't know if it'll happen, but based on putting all these pieces together, is what could happen. You could have 50% plus unemployment in this country, no welfare system, no unemployment benefits, no Medicare, Medicaid, or at least very limited, and Social Security will be pretty bankrupt. So, basically no government support and people having no income. What comes of that? You'll see some bartering, you'll see some of that, but basically people are going to be, trying to survive, and that means dog eat dog. I hope I'm dead wrong. It's what I fear, but again, it's still a ways out. So I tell people there's going to be enough happening this decade. Focus on getting your house in order this decade. Take advantage of what you can in the markets this decade, and try not to lose sleep over something 10 years out. As a macro strategist, I have to stay away from giving any advice or providing any recommendations. So what I can do is use my forecast to kind of give a broad framework and people can probably read between the lines and figure out from there. But they've got to figure it out for themselves. In the bust. So people get confused because I talk about this collapse in the 2030s. There's a bust next year. Doesn't mean the whole system's going bust. It just means it's going to be bigger than anything we've seen post-World War II, I think. Biggest financial crisis maybe in history. But we come back from it because of the printing press. The problem in the 2030s is because you'll have hyperinflation, the printing press is unoperable. You can't use it. If you print more money, you're going to get the Weimar Republic. So basically, printing press is taken off the table in the 2030s. That's why you collapse. Because we're heading towards a deflationary global bust next year, in my opinion, that means you have almost infinite ability to print money and get yourself out of that. And that's what they'll do. So as a result, you've got to focus on next year, but not the 30s. So when I give this forecast, it's about what's coming right in front of us. So my view is, from a forecast standpoint, there are going to be a couple assets that will buck the trend and hold up against the falling asset situation that you have. Like I said, the stock market, I expect to drop 80% peak to trough. Corporate bonds, particularly junk bonds, I think are going to get hit very hard. Could lose more than half their value. Higher quality corporate bonds are going to probably fall, but not fall nearly as hard. And the only things that I think will hold up and not fall are treasuries, and treasuries of all maturities from T-bills out to the long bond. I think because rates are going to fall through the floor, I'm forecasting a 10-year to 2.5% this year during the meltdown. Then they could back up some for one reason or another. Fed might react to the strong stock market and raise rates, or just a correction in bonds, whatever. But then during the bust, I think rates can fall. The 10-year can fall to 0 or below. Short rates can fall to negative territory. 30-year probably can fall to a half or a quarter. So you've got obviously appreciation in bonds if that happens, in treasuries, in government bonds. You will have a big premium. People will run to the treasuries because of the government guarantee. And because of the printing press, our governments are not in trouble this time, or at least the U.S. government is not. There's no default coming in the bust because they'll just print more money. So treasuries are the one thing that I think will hold up during the bust and actually appreciate probably in certainly the longer maturities. The dollar, I'm calling for a U.S. dollar, the DXY, to fall to 80 in the next 9 months sometime. So, we're at 104, just dropped below 104 today. That's a big drop from 104 to 80. But I think most of that happens before the bust. Some might happen in the first few months of the bust. I think the world is going to run to the dollar as they always do, as the flight safety trade. So I think the dollar gets bid back up. So if I'm right that it goes to 80, I also think it can go from 80 back to 120 or above. So during the bust, I think, and again, people have to be careful. If it's still falling, don't say, well, the bust started, I'm buying a dollar. The dollar may continue to fall in the first few months of the bust. I'm not sure. But I think you'll have a big run in the dollar at least through much of the bust. So in this country, FDIC insured savings and bank accounts up to the $250,000 limit, I think are safe because they have that printing press and they will fund the FDIC to whatever is necessary to protect that. Money market funds is a little trickier. In 2008-9, they had the, don't break the buck policy where it stayed at $1, and so you didn't lose in the money markets once they inserted that policy. I would suspect they'll do that again because they have the printing press, but it's not a given. It's not something we have right now. So those things probably protect you. Overseas, it's harder for me to say. It really depends on the government policies elsewhere.